Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk. If you have mutual funds, whether with a financial advisor or in your own discount brokerage, or want to buy some, how do you know if the ones you have or which are the good ones? You can do research yourself and check. Go to Morningstar.ca, an independent research company, and find the mutual fund's 3-letter and 3-digit code in the Search Quotes and Cite field. Morningstar is a great resource with plenty of investing articles as well. To see some of the information, you will need to create a free account. Let's run through some definitions. A mutual fund is a basket of investments, whether stocks, bonds, real estate, gold, cash, etc. A management expense ratio, called the MER, is the percentage of assets the owner pays for owning the mutual fund to the company that administers the mutual fund. You never see the MER being deducted, and all the results that you see are after the MER has come off. A balanced mutual funds includes stock, which is ownership in a company, and bonds, which is a loan to a government or a company. Let's go through some pros and cons of mutual funds, and keep in mind there's two kinds of mutual funds, actively managed and passively managed. Let's go through the active mutual funds first. The active mutual funds is shares in a bucket of stocks or other assets. They are bought and sold overnight as opposed to trading during the day, and it has a code of 3 alpha and 3 digits, such as MAW108. It has a management expense ratio, the MER, of 1 to 4% per year, and there can be penalties for early sales, especially if you're using a deferred sales charge, which I will explain later. The benefits are diversification. A human is making decisions about the choices of the assets, and there's usually no commissions to buy and sell. The downsides are the high fees. The salesperson may have a conflict of interest, and it will often underperform its indexes. A passive mutual fund is shares in a bucket that follows an index, also bought and sold overnight, and also has an alpha and digit code such as RBF 556. It will have a management expense ratio, but this time it will be between 0.3 and 0.8% per year. Benefits include diversification, and as usual, there's no commissions to buy and sell depending on your brokerage. The downsides are that it's passively managed as opposed to being a human managed, and it will usually equal the index in its performance, but it won't outperform the index. Please do note that all performance on a prospectus is stated after the fees and the MERs have come off. So you would want to look for mutual funds with great performance rather than just looking at the low MER. Be aware of the MER, but it's the performance that matters. I wanted to say a couple of words about mutual fund loads or fees. Mutual funds can have loads which are mostly not used anymore, so I'll just go through some of them. The first is the front end, or the FE, where you can be charged up to 5% upfront. There's the Deferred Sales Charge, or DSC, which is a decreasing charge if you sell before 7 years. This has been made illegal in most of Canada except for BC, and this is where a financial advisor will get a 5% commission immediately upon selling you one of these. Next is the low load, or LL, which is also a decreasing early sales charge, but it's usually limited to 3 years. Finally, there's the no load, or NL, which means you can sell at any time. So what you would be looking for in your mutual funds would be either front end zero or the no load version. Just as a general suggestion, I wanted to caution everybody to compare their portfolio or their mutual fund performance to the indexes of that mutual fund or the portfolio, the benchmarks. What a lot of people do is they go to their financial advisor and they will say, how did my portfolio do? And the financial advisor says, you did 10% this last year and everybody's happy. Or they say, oh, sorry, you lost 5%, and then the owner is sad. What you want to do is you want to compare your results to how the overall market or the benchmark did. So if your financial advisor says you did 10% and the market did 8, then you have good mutual funds. If your financial advisor said, oh, you lost 5%, but the market lost 8, then again, you have good mutual funds. So don't look at the performance in absolute terms, look at it relative to the benchmarks and to the market. So how do we analyze a mutual fund? Let's take a look. I'm showing you a mutual fund for illustration purposes only, so please do your own research. This is a balanced fund, so it has both stocks and bonds. The mutual fund has to beat most of the other mutual funds in its category. See the stars at the top. What you want is 5 or at worst 4 stars. The best 5-star mutual funds, despite the MERS, will outperform other mutual funds in their category. The star rating, 4-star means that 70% of other mutual funds in the category are below it in risk-adjusted performance, while 5 stars means that 90% of mutual funds in that category are below this mutual fund's performance risk-adjusted. So you're looking for 4 or 5-star funds. The second way to look at a mutual fund is how it performs against its indexes, which are benchmarks containing similar assets that you can compare the mutual fund against. So you want the mutual fund to perform better than its indexes rather than just following them. Therefore, an actively managed mutual fund, if it is a good fund, will outperform the index tracking passively managed index funds. So to summarize the basic analysis of a mutual fund, you look at it from 2 dimensions. One, and shown by the star values at the top, is how it performs against other mutual funds in its same category. And the second dimension is how it performs against its indexes. So you want it to be a 4 or 5-star fund, beating the other mutual funds in its own category, and you want it to be outperforming its indexes, as you can see from the chart, by the blue being above the red and yellow of the indexes and the benchmarks. Next is the metrics at the top of the description. The NAV doesn't really matter. What matters is whether it goes up or down, but whether it's $10, $20, $30, $40 a share, that doesn't really matter. What matters is the change once you've bought it. Next, we have the fund size. That's only important once it starts getting very big, because then the mutual fund becomes like an ocean liner. It is very hard to churn. And so if you have a fund size of 10 or 15 billion, there is the danger that if they want an investment that they feel is at a good price, as they start buying it, they're buying so much of it that it goes up in price and they're not getting it at as a good price anymore. Next is the TTM, which stands for trailing 12-month yield. That's the dividends that the assets pay in cash to the owners of those assets and in turn to the owners of the mutual fund. The MER is the management expense ratio, which we've talked about. You want it to stay reasonable in that number. The share class type, you'll encounter 3 types. Number 1 is the do-it-yourself. That's for people who don't have a financial advisor and use a discount brokerage, and this will probably have a lower MER as a result. Then you have commission-based advice. That is when you have a financial advisor giving you advice, and therefore they're getting a commission for selling you the mutual fund as well, and so that will be reflected in the MER. And finally is fee-based advice, which is where the financial advisor gets paid by the hour, and as a result, the owner pays the financial advisor separately, and the MER ends up being lower. because that version of the mutual fund doesn't pay anything to the financial advisor in commissions. And lastly is the minimum initial investment. That is the amount that you need to buy when you're first buying this mutual fund. It's usually on a per account basis, so it's not on a per mutual fund basis. So in this case, you need to put in $5,000 into your RSP, adding together all Mauer mutual funds, not just one mutual fund. So it's actually a little bit less onerous than you would think. The next line of metrics shows the following items. Number one is the category. So you would want to check the category so you know what the fund invests in. It shows both geographical and asset type investments in the category. Morningstar has about 60 of them, so they get quite specific. So please be aware of overall what this fund is investing in. Number 2 and 3, we will check in more on later, but I'll cover them quickly now. Number 1 is the investment style. So on 2 dimensions, you have small, medium, and large companies that it invests in. And on the second dimension is the stage of development that those companies are in. And you can have value, blend, or growth. The second one is for bonds, and that's the credit quality and interest rate sensitivity box, where credit quality indicates the types of companies that the mutual fund is buying bonds from. And you would want the credit quality to be higher, but then the return is a little bit lower, but it's safer. And then the second dimension is the interest rate sensitivity, which is basically an indication of the length of the bonds, where longer term bonds are more sensitive to interest rate changes. And bonds act in inverse to the interest rate changes. So if the interest rates go up, the value of the bond goes down. If interest rates go down, the value of the bond goes up. And of course, the longer the bond duration, the more they are affected in either of those two ways. Next is the turnover. So this is the number of times that the mutual fund changes the assets that it is investing in. And therefore, this is important for taxes in non-registered accounts, because if there are capital gains or capital losses from price appreciation or depreciation when those assets are sold, that gets passed on to the mutual fund owner, and therefore you will have to pay taxes more frequently if there is a higher turnover. Next is risk level. This is just an overall indication of how risky and volatile, both up and down, the price changes of this mutual fund are going to be. The ratings are low, medium, and high, with intermediary ratings such as medium to high being possible as well. This particular mutual fund has bonds, so they scale down the volatility, so you're getting a medium here. Bonds are generally less risky than stocks. And finally, there is the inception date, which is when the mutual fund came into being. It just shows when it originated. And so you would want to have at least a 5-year history, preferably 10. 15 would be even better, to see how this mutual fund has performed. Next is the annual return by year, comparing in a table the mutual fund to its index, the category, and other funds in the category. You want the plus minus numbers to be positive, meaning the fund beat them, and you want the quartiles to be in the top one, and the percentile rank to be low. You want the mutual fund to outperform the index's performance. This next table shows the fund's annualized performance for various time periods. That is, the percentage shown is per year, even if the time period is 3 months or 10 years. It's also compared to the category and the index again. You want the plus minus numbers to be positive, meaning the fund beat them, and you want the quartiles to be in the top one and the percentile rank to be low. You're basically wanting the fund to outperform the index. The star rating is shown calculated for periods 3, 5, and 10 years. This fund also has a 15-year information because it has been around for so long. But as you can see, the 5-star ratings are what you are looking for the 3-year, 5-year, and 10-year periods. In the Portfolio tab, you can see how the investments of this fund are distributed between Canadian, US, international stocks, and the fixed income bond component, and compare these weightings to the category and index. Short and long means the fund is expecting the value of an asset to go down and up respectively, and so have set up their investments to take advantage of this. This fund is expecting everything they own to go up in price. The market cap table shows the sizes of the companies the fund invests in. The larger the company, the less risky it is, but the increases in price are also limited on the average. And we're comparing it to the category and to the index in this table as well. The stock style grid shows company information in 2 dimensions. The vertical axis is the size of the company invested in, graphically showing the previous table's info. This fund invests in large or bigger companies on the average. The horizontal axis of the grid shows value, blend, and growth. Value are typically companies that pay a dividend, a monthly, quarterly, or annual cash payment to the owners, and/or are underpriced. Growth means companies that are increasing in size and generally reinvest all their profits. Blend is companies in between those 2 extremes, often termed as GARP, growth at a reasonable price. Growth and value take turns outperforming each other, so it is good to diversify and have both types of mutual funds or a blended outlook. Scrolling down, you can see how the investments are divided into the 11 sectors, in case you have a preference and knowledge of which sector will do well. Now, since you are paying the MER, you are paying the fund manager to make all the stock selection decisions, and this should be for your reference only. You can also see how the fund compares to the category. There will need to be differences between the fund and the category, so the fund can actually outperform the category, so don't be too worried if there are significant differences. Flipping over to the bond information, you can see where the fund puts its 34% of total assets into bonds, which are loans. Government bonds are safer but pay less than corporate bonds, but governments hardly ever go bankrupt, and thus the borrower will likely pay back the loan. A more detailed breakdown of the bond quality is in the A and B ratings of credit quality. Higher up in the chart is safer but pays less. The fund is again compared to the category, which in this case is showing more risk than the fund. The length of the loan, also known as bond duration, shown in the effective duration and modified duration information, determines how the bonds are affected by changes in interest rates. The longer the duration, the more a change of the interest rate by the central bank affects the bond price. The fund has bonds that are significantly longer than the category in this case, earning a higher interest return by the loan, but also being more affected by the central bank interest rate changes. The interest rate sensitivity and the quality of the bonds are compiled into the fixed income style box, with the quality, chances of the organization going bankrupt, being on the vertical axis, and the interest rate sensitivity, limited, moderate, and extensive, being on the horizontal axis. This particular fund has bonds of high quality, but as interest rates go up, the bonds lose some of their value more at a higher rate than other bonds might. If yours is a mutual fund that only has bonds, that is a bond mutual fund, then you will only have the bond information and you will not have any information about the equities. Morningstar's website has search capabilities in the Funds tab to enable you to find the best mutual funds. You can either use the 5-star funds search, which will show you all the 5-star funds, or use the regular fund screener with a lot of different parameters to choose from if you are looking for a mutual fund that invests in a specific geographical area or sector. So to summarize, know what mutual funds you have, roughly what they invest in, how they are performing compared to their own index and their category's other mutual funds is important, so your money is working hard for you. Please take a look at your funds and ask your advisor if something doesn't seem quite right. If you have any requests on what you would like to cover in future videos, please put that in the comment section. Like, subscribe, ring the notification bell, and may you have a profitable day.